Good morning and welcome back to the latest edition of the InvestTalk Market Analysis for the week ending October 20th, 2023. Appreciate you all tuning in, liking, and subscribing to this channel as well as our podcast, InvestTalk. And today I'm going to title the video, Precious Metal Bull Market Arrives as War Drums Beat Louder. And we all know what's happening in the Middle East and in Europe, and obviously that's good for safe haven assets like gold. What's interesting though is that the U.S. Treasury is no longer a safe haven asset, and so is gold the new safe haven asset? Is it taking over for treasuries, kind of its historical role? And maybe that's why the precious metal bull market is on. Okay, so we're going to talk about that. We're going to talk about, are we going into a stagflationary environment? What is stagflation? We're going to give you a market update, especially on that 10-year yield, which is so important to what's happening in the broader markets. But let's first focus on what the Fed is likely to do going forward. Obviously, there were some dovish comments last week. This week, there was modestly hawkish comment, shall we say, out of Jerome Powell, but that has that kind of waned, right? That hawkish stance that he took, I think it was on Wednesday, was overridden by a weak equity market. And now, a month ago, we were at a 26% chance of a rate hike in a week and a half on November 1st. Now it's a small, very small 0.1% chance that we'll get a rate cut. So very interesting to see the movement in what the markets are pricing in. And that's another reason why gold is getting a move here. And you see for December, there's also now a 0.1% chance that we'll get one rate cut by the end of the year and 20% chance there'll be one rate hike. But obviously, that's a big move from a month ago. 38% chance that we were going to get another rate hike, and a 6.7% chance we were going to get two hikes by the end of the year. Now that's at zero, and the cut is at 0.1%. So that is really sparking the rally in precious metals and gold and silver, and we're going to talk about that. But let's dig into the economic data this week. Not a whole lot, but you did have industrial production tick up a bit. That was a positive. Retail sales held strong, excluding motor vehicles and parts. That was down to 0.64% growth, but still growth nonetheless. Earlier this year, we were getting negative month-over-month increases. Now we're still getting positive, and a lot of that's being held by the baby boomer generation with a lot of wealth. I think something like $77 trillion in wealth. They have a lot of their homes paid off. Even if they have a mortgage, it's probably locked in at 2.5% or 3%. They got an 8.7% raise in Social Security. So if you look at, I talked about that yesterday on the show, if you look at where the strength in the consumer is, it's definitely in the older generation. And you had the New York Fed Business Survey. That one was the weakest since, going back all the way to January. And obviously that's a Fed survey, so they're going to be talking about that coming up in a week and a half on whether or not you should raise again or maybe a cut. And so there could be a signal coming up, I think, in the next meeting that a cut is the next move, not a rate hike. I think that's what they're going to start to move their rhetoric towards is, okay, we're done. We're done raising rates. The move in the long end of the curve, and the 10-year Treasury rate, for example, is doing a lot of the work for them, and they don't need to raise any more, and that will be incremental towards a rate cut sometime next year. And that's where I think is headed, and that's why you're getting that move in metals. And the dollar isn't quite weak, which I'll get to. I'll give you a market update in a second, but something to keep an eye on and where I expect policy is headed. Building permits month over month down 4%. Housing starts, however, up 7%. So a lot of choppiness here. I still think you're going to get relative strength overall in the housing market, not the housing market, the new home market. The lack of supply in the existing home market is allowing home builders to continue to build and maintain pretty good margins and move product. And it's hard to see a big downturn in the economy when the construction spending remains relatively robust, or construction employment, remains relatively robust. I wanted to show you this panel. And what you can see, this is Friday's move. You saw growth stocks definitely taking it on the chin more, but look at the 1-year returns. And what you can see here is utilities the worst, all the bond proxies. Real estate down 5.69%. That's also the same for the last month, right? Down nearly 10% on both. The best sectors, energy, over the past month. And I think you're going to start to get that as a pocket of strength here as we go into next year. You're starting to see some weakness in technology, right? Down 1.74%. But that is the best performer of the last year. But I do think that's going to shift. I think this is a time where you're likely to see an inflection point in markets, and I do think rates will peak out over the next couple of weeks. Maybe call it 2 to 4 weeks, maybe 4 weeks. I think more like 2 to 3 weeks, but we shall see. But I want to show you that, just kind of give you a sense of what's happening over the past year as well as the past month. What other sectors have been weak over the past year? Financial services only up 0.5%. Consumer defensive, those staples, also bond proxies, barely up year over year. And basic materials, that's been good, 9%. Consumer cyclical up 11%, shows you how strong those markets are. Energy up only 6%, but I think there's a lot more room for that to move higher. And you can see that the 1 month is starting to catch up to the rest of the market. Healthcare, only up 2%. Another kind of bond proxy, a lot of issues in the healthcare space, down 3% on the month. So I don't think this is I think this is a market that you don't want to chase these returns. I don't think this is going to look the same a year from now. It's going to look very different, especially because you're likely to see a Fed pivot coming up. Now, let's pivot over to a market update. And we're going to start off with this gold to S&P ratio. And this is a weekly chart. This peaked out in early 2020, and then you had this, and that's when basically the depths of COVID, and then you had a rally in stocks all the way until 2021, the end of 2021. That's when growth stocks peaked out. It's when the S&P peaked out, and now you're seeing this uptrend in gold prices in relation to equities, and I think that is a strong indicator. Look at this move. This is a powerful move and indicates that the precious metal bull market is on. So it's an important chart to watch and start off with this market analysis. Now, the 10-year yield almost hit 5%. We didn't quite get there. You can see that this is a 5-minute chart. So we didn't quite get to the 5%, but we did get there on the 30-year Treasury rate. And we're at 5.09, hit almost 5.15 on Thursday. And, this is the long end of the curve. And this is what I was talking about. A lot of supply coming on market and pushing the long end, the term premium. That's what this is talking about. It means the longer you go out, the more term you give on a bond, the higher rate you are receiving for that. Okay. So that's when you talk about the term premium, that's what it's speaking of, is that the yield curve is actually uninverting. The short-term rates are staying relatively flat. And you can see that if we go back to this chart here is the yield curve. Okay. And if we go back, we can even delete. I thought you could change the time period, but you can't on this one. But basically, this is flattening out. Okay, and you can see that here, 20 years at 5.25. That's basically flat from where we are on the short end. 10-year, right at 4.93 at the close today. So I expect that to continue to rise, and something that you have to be cognizant of long term. I think rates are breaking out. Go back to a quarterly chart. This is the 10-year rate chart on the Treasury, peaked out at nearly 16% back in 1981, and then you had this long stair step lower. And remember the old saying in markets, stair step up, and elevator down. And what you can see here is, remember, this is inverse to bond prices. So as you had that stair step over 35 years, with bond prices moving higher, yields lower, and now you're getting that actually elevator down. That's why you're seeing such a violent move. And you saw that back in the 60s, right, where rates just powered higher. The 10-year went from 4.6 all the way to 8% in just, let's see, it was that 67 to 69, just a 3-year period, kind of similar to what we're getting now, right? So that was basically a doubling of the rate. And we've seen that and then some from where we're at now. And then you saw that other leg higher in the late 70s. Okay. So you can get pullback periods. You had that for, multiple quarters, 4, 5, 6 quarters. And could you see that now? Pulling back into the maybe around the 3.5% level in the 10-year? I think that's certainly possible. But but long term, you're seeing that rates are likely moving higher. So for a trade, duration risk probably makes sense, but long term, owning duration is not going to be a great place to be. So I wanted to highlight that. Now let's look at the broader equity markets. Here's the NYSE. Let me zoom back into a daily. And that is threatening to retest these lows from June, and I think it will next week. This is near term. You have to be somewhat bearish, but overall, you're still in a broader uptrend, and you're not getting a major credit market breakdown. Here is the SHYG to the SHY, so basically short-term junk to short-term treasuries. And this is showing that credit spreads are widening out. When this drops, credit spreads are widening out, a higher likelihood of a recession, of some sort of problems in the credit markets. But overall, you're not breaking these lows. So until you break these lows, then you're just more in a longer-term trading range. And that's kind of what we've been in, right? Look at this ratio. Just in this trading range basically since summer of 2022. Summer of last year. And that's when central banks brought more liquidity in the market. And I expect them, if you get down to these levels again, for them to come back in. And the main signal will be the dollar. Will the dollar reverse? Will the dollar reverse? This momentum has paused. And you see the MACD rollover. And that means the next move is likely down. Likely. Okay. Now, I want you to notice here when the dollar started to make its rally. Mid-July, okay? Mid-July. What did the S&P peak out? Basically mid to late July. And we've had pressure to the downside ever since. So if the dollar can roll over, that's going to bring a more positive sentiment into risk assets, equities. And so while I think you likely see a little bit more downside over the next week, maybe 2 weeks, you're likely to still get that year-end rally unless there's something major breaking, and I don't see that quite yet. Okay, we'll pivot over to the VIX. The VIX up to 22, not a panic mode like we saw during the banking crisis, but above 20 is a elevated volatility, and especially in a time where we have zero DT options, it kind of skews the VIX a little bit. This is a pretty this is a level where sentiment is pretty bad. Okay, so something I'm watching for a reversal there. An uptrend in the VIX is obviously bad for equities. Move index, another aspect to watch when you're looking at the treasury market and a potential Fed pivot. This is consolidating for a breakout. I've talked about this before. It gets above 150. This is the volatility of the treasury market. Last fall, you had a panic in the gilt market, in the JGB market, when this is above 150 and the Fed pivoted behind the scenes. This is the fall or the spring with the banking crisis. What did they do? They expanded their balance sheets, and they implemented the policy that allowed these banks to take these underwater assets off their books, off their balance sheet. So if this breaks out above 150 again, I think the dollar rolls over. I think you get Fed coming out maybe on November 1st saying, hey, we're done, and making that pivot in earnest. Okay, so I'll be watching for that. Now let's get over to just simply the gold market, right? We talked about the gold to silver ratio. This is a massive reversal and tells you this precious metal bull market is back on. It's on, okay? And the only thing really holding it back, I think, is the silver to gold ratio. This isn't a clear breakout. It's improving. Let's see if That's why I didn't type it in right. There we go. This is improving, but it's not back to, it's not back into that uptrend. So I would like to see this get some traction to the upside. It's improving over the past couple of weeks, but until then, I don't see. I'm hesitant to say we're not going to get some consolidation. I think we could get that, right? This big move usually means we're overbought, right? We are overbought in most of these signals, but the MACD is turning up. You can see that, and I would see some consolidation unless you get that dollar really down. Dollar really reverse in earnest, then you're really going to get those prices in gold and silver higher. Let's go with the commodity index more broadly. And what's interesting is it talked about that peak in the bottom in the dollar in mid-July, and look what commodity prices have been doing. They've just been really chopping sideways, consolidating after this move in June and into late July. So that is extremely good relative strength. And you go look at the USO, that's been going higher as well in the face of the stronger dollar. So you have to be very bullish on commodities in general and precious metals in this time. So I'll be watching for that dollar to reverse, and I think we're going to get a major move in commodities as we close the year and into next year because of geopolitical reasons as well as lack of supply. Let's look at growth to value. Starting to see that roll over just a bit. Start tempted to break out again, right? For the third time, we've had this consolidation. This is when it paused in June. You try to break down into early August. Tried your second breakout. Now you're on your third breakout. If this reverses, I do think it reverses in major earnest. And I think you get the value side of the market retaking its lead that it had in 2022. Remember, this is a ratio. If this goes down, that means value is outperforming growth. And all of 22, that was going down. We've had this rebound, but we're into major resistance. And look at the MACD, making a lower high. There's divergence there. I think you're getting that peak out in the growth side of the market. I think that's about it. Once again, near term, here's the S&P. We didn't quite hit that 4,200 level on this recent move down. Got a bit of a rally. Wouldn't shock me to actually get there to 4,200. That's major support right around 4,178. This breakout area, I think that's where we get to next week. And probably reversal. Could we get all the way down to 4,050-ish, that area? That's certainly possible. But I think this is that major support level as we head into the next couple of weeks. So near term, slightly bearish, but still modestly bullish into year end. I don't think we get to new highs by the end of the year, but do you get back to 4,400, 4,500? I think that's certainly possible. So that's where we're at. Appreciate you all tuning in and liking and subscribing to this channel, as well as our podcast, InvestTalk. A reminder, the contents of this video are for educational purposes only and should not be considered as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.